Okay, welcome everybody around this table, and those of you who are listening in wherever in the world you happen to be. Marianne Nessen and myself will go through the monetary policy report this fall, and in addition to what's in the report, Marianne will also comment on a special section on the functioning of the labor market that we have in there. But of course, as always, we are here to reflect and answer whatever questions you might have. So our message this time is that the repo rate stimulates the Swedish economy, and as far as we can judge, it will stay low for quite some time to come. And we have pushed the interest rate path a bit to the right, and the major reason for doing so is basically what's going on in the rest of the world, not the least what's going on in Europe, because if you look at, let's say, Swedish exports, and I'll get back to that, then demand will be on the low side for a while, but eventually things will be fixed in Europe and also in other parts of the world, and things will normalize. So another part of the way we look at this is to say that we're not talking about 2008 or 9. This is something, at least the way we look at it is more normal, and something we can more easily recognize compared to that very unusual episode. Financial markets are fairly calm. You can do this. You can try to measure this in many different ways. We've done it over the years, also in many different ways. Looking at the long rates here, if you look at Sweden and Germany, nothing much really has happened since the summer. The rates have been bounced around a bit, but not dramatically so. On the other hand, looking at Spain and Italy, rates have come down, and that's partly because of all the various measures that have been taken by the ECB in order to keep the system going in one way or the other. But that's not saying that everything has been fixed. So it's more kind of, I don't know what to call it, for lack of a better word, buying time until things actually get done, and there's still a long way to go. And one can see this more clearly today than, let's say, 2 years ago, or maybe even 4 or 5 years ago when all of this started, because it's quite clear when you look at Southern Europe that they have a number of structural issues that kind of were a bit hidden over quite a number of years, and it worked while credit kept flowing to these parts of the world. But when that stopped, then you end up with all the structural issues that you know about and they are dealing with. Unfortunately, still we have lingering problems in European banks, and that's why there are a number of issues in terms of the interbank money market, putting a lot of money from the ECB side into the system. And then finally, a number of political decisions remain. At the EU level, we're talking about medium to long-term issues mostly, but then those issues get intertwined with what needs to be done in different countries now, and then that takes us to the national level, where a number of countries have to do what they have to do in order to sort out their problems. But that's not so easily. It's more easily said than done, because we don't have all the mechanisms that you need in Europe to deal with that. And then on top of that, eventually, in this world, countries still have to do what they have to do when it comes to go through the structural change that will happen in one way or the other. And this means that in terms of Swedish monetary policy and our view of the Swedish economy, our baseline scenario is to say that this is 2 steps forward, 1 step back. It will take some time. It's not clear how it will evolve in the individual country cases, but on average, things will improve over time. One should maybe also be mindful of the fact that now we have been at it for 5 years when it comes to dealing with these issues. Whether that is good news or not so good news, that's for others to judge. So we have a slow recovery in the euro area, the red dotted line, which is not that surprising given that what's going on and what countries are struggling with. At the other extreme, we have the BRICS, which will continue to grow with the year, using Europe as a measuring rod with a very brisk pace. And then we have the US in between. And this time, a novelty of ours, we have added a KICS graph here, the gray one, showing our projection for 30-some major trading partners of ours. And it's not that surprising then actually that the gray line is actually is fairly similar to the one that I'm going to get back to when I talk about the Swedish economy, but because that kind of follows from the interconnectedness that we have between us and the rest of the world. We have weak demand for Swedish exports. The blue line shows other people's imports are our exports. And then we have Swedish exports, the red line. Clearly, these numbers will always be fairly close to each other. It's also easy to see here that the numbers are low presently. But once things improve in the rest of the world, the demand will pick up again. And that, of course, is a very positive process for us. What is not in this on this slide is that this also will produce a substantial current account surplus for us as a nation over the period that we're talking about here. And in that sense, it's an element of stability that will stay as far as we can judge. We think that the households will continue to consume at a relatively good pace, fairly close to the average, lower now, but when things improve a bit higher than average, because over an extended period of time now, actually, we have had a very good real income increases in the household sector, and that makes it most likely that the households will have good opportunities to continue to consume. But all in all, we can't escape what's going on in the rest of the world, and that means that the Swedish economy is slowing down. But on the other hand, what hasn't really changed at all, if you look at the projection here, is that in our judgment that things will improve going forward. What you are aware of is the issue that we had in the course of the summer and early fall, in terms of what are the actual numbers actually supposed to be when it comes to the second quarter, but that has been sorted out, and that doesn't really affect our growth projection, looking at what's we think is likely is going to happen in the future. But given that we are where we are, unemployment is rising slightly. There are two elements to that. One is the conjuncture, and given that as far as we can judge, it will take longer before growth comes back in Europe. And the other part is the functioning of the labor market, and Marianne will talk more of that. All things considered, then when we add things up, we think that unemployment will go up a bit, and then eventually come down when growth normalizes. But it will take longer than what we have expected in the past, given the structure of our labor market and given what has happened there. Inflation is low presently for three reasons. If you look at what has been going on right now, the krona has appreciated over a period of time. That lowers import prices. We have had very modest unit increases in unit labor cost. And then finally, lately we have had falling energy prices. But nonetheless, when aggregate demand picks up again and when things normalize, that will bring more inflationary pressure into the system, and then we will gradually move towards our 2% target again. And as always, given that our CPI includes interest rate hikes, that will mean that the CPI will eventually overshoot. But that's a natural consequence of monetary policy and how these things are designed here. So we think that low repo rate continues to stimulate the economy. The repo rate, the interest rate path has been pushed a bit to the right. It will take longer before things normalize in terms of a nominal repo rate. And then, of course, this slide kind of speaks for itself in the sense that the rate peaked at 2%, and that's because things did not normalize that time. So now we are kind of moving to the right here, hoping that things eventually will normalize in the rest of the world in such a way that we will also end up with normal growth numbers in the Swedish economy. If that were to come sooner rather than later, because we have strong domestic demand, that means that interest rate hikes are coming rather sooner than later. But on the other hand, if something really unexpected were to happen in Europe, something that we can't really predict today, then that would most likely, in terms of a bad outcome, produce lower demand, lower exports, and that would then push interest rate hikes further into the future, or maybe even lead to a lower policy rate than the one that we presently have. But all in all, this is where we are when it comes to Swedish monetary policy. The rate is likely to stay low until sometime late next year, and then provided that our baseline is correct, things will normalize, and that means that then also gradually over time monetary policy will bring us back to a higher nominal rate compared to the one that we have presently. Marianne.
Okay, thank you. And well, we have four articles in the report. One is on recent events in the euro area, handling the crisis. One is on wage negotiations. One is on the switch from the KIX index, from the TCW to the KIX, and a fourth box is on how the labor market is functioning. And I thought I would talk about that a little bit because that explains, it's one reason why our unemployment forecast has been revised. So as you perhaps have noticed, our unemployment forecast has been revised in 2013 and 14. So in 2014, it's been pushed up by 0.5 percentage point. And one reason why we're doing this is that we see signs of lower matching efficiency in Sweden. I'm going to talk a little bit more about that. And I mean, if you look at the composition of the workforce, there are groups there with so-called lower labor market attachment, and their share of unemployment seems to be increasing. And as I'm going to show you, the beverage curve has shifted outwards relatively much compared to other countries. And we also have some other graphs that I'm not going to show you. It's a long article. I can recommend it. It's full of facts and tables and figures and technical stuff. So I'm not going to talk about everything. But all in all, we see signs that the matching and efficiency has deteriorated. And this is one reason why we've changed the unemployment forecast. So 4 panels in this graph. The upper left-hand panel is unemployment, and there you will see that in the past 15 years, unemployment in Sweden has rarely gone below 6%. In the July report, you may remember that we had an article about the long-run employment level, and we landed in an interval that saying that we expect that in the long run, unemployment is somewhere in the range of 5 to 7.5%. Now, if you look at the people who are unemployed, and I'm now going to talk about the upper right-hand panel, and going to look at 2006 and 2011 and compare those two years to each other. In 2006, unemployment was 7.1%. In 2011, unemployment was 7.5%. The red and blue and yellow bars add up to the figures that I just mentioned. So in 2006, 3.5% of the 7.1% of the unemployed were those people were between 25 and 54 years of age. So if you compare the red, blue, and yellow bars 2006 with the same ones in 2011, you will see that there are more young people in the pool of unemployed. If you go down to the bottom right-hand panel, you will see that the number of people that are born in other countries than Sweden have increased as a percentage of the unemployed. Last, the lower left-hand panel divides the pool of unemployed in terms of what kind of education they have, and there the difference are not so big between 2006 and 2007. But all in all, an increasing share of young people among the unemployed, and foreign-born people among the unemployed. Now, this could just be a simple reflection of changing demographics in Sweden, but if you look at these groups have been identified by the Swedish Public Employment Service, Arbetsförmedlingen, the Swedish Public Employment Service. They have identified these people as vulnerable groups. They see signs that these people have a harder time finding jobs. So what do we do in the article? Well, we go through some statistical evidence to see how the functioning of the labor market has it improved, has it deteriorated. And one sign of a deterioration in the functioning of the labor market is the classic beverage curve. This beverage curve, you've seen it many times before. In this particular case, it starts in 2001, and you will see a bunch of observations that lie on this sort of the slope with the negative slope between 2001 and 2007 or 8. But after that, you will see signs that the beverage curve has shifted out, indicating that there is a poorer efficiency in matching in the Swedish labor market. In the article, there's some other statistical analysis, which also gives strong support for the conclusion that matching efficiency has deteriorated in the past few years, and also, of course, Konjunkturinstitutet, the National Institute of Economic Research, they had a box on that in their latest report. So we've sort of come to the same conclusion. So what does that mean? What has that meant for us? The matching between job seekers and vacancies has deteriorated in recent years. So we now believe that it will take longer for unemployment to fall. And this is one reason why the repo rate path has been lowered. Now, the poor matching, that cannot be solved by monetary policy, but the effects of the poor matching can be addressed by monetary policy. So part of the lower repo rate has to do with the higher unemployment due to the lower efficiency in the matching.
Okay, that's where we are. Questions, reflections on this? Who wants to start?
The conference has been unmuted.
Well, perhaps may I start with a question regarding the labor market in your special... regarding the deteriorated matching situation, are your estimate for the NIRO now a little bit lower compared with your previous calculation? Or higher, I mean.
Rather higher.
Yeah.
I mean, as I said earlier, in our July report, we reported an interval. There's a lot of uncertainty here. This analysis that we present today, we haven't sort of revised that interval. I think this goes well hand in hand with the uncertainty that we signaled so clearly during the summer.
We are quite comfortable with an interval instead of a number, and this is part of the background to that.
Sure, but in our internal calculations, I mean, we have to put a figure into our models, not an interval. So we haven't changed that. It's the middle of the interval.
Just following on to that, there's been this discussion at the Fed regarding also the beverage curve in the U.S., and some of the people there have argued that it's typical that the beverage curve shifts out in a cyclical downturn when there's been a financial crisis, and it's not a structural phenomenon. How do you see that as well? That's cyclical.
We haven't had a financial crisis, so in that sense, these things are really difficult to compare. I mean, if you want to use that argument, then you would have to look at our numbers from the 90s. But looking at the numbers from the 90s, then you have the same phenomenon in the sense that the numbers just dramatically went up. Yeah. And then actually those numbers haven't come down since then. And in that sense, of course, it's a serious issue.
Yeah. If you take this graph back to the 90s, you've seen this all. All those points are inside. So we've sort of had these three phases. It looks like.
And this second question I'll ask is something you alluded to, that is monetary policy the most efficient way to fight unemployment, or is that financial policy?
I mean, there are parts of it. I mean, we deal with aggregate demand, and then you have all these other issues that are not for us to deal with and that we can't deal with. And in the end, it's the whole package that matters, whatever that means. And if some of these parts end up being in some sense unbalanced, then you end up with putting too much on, let's say, monetary policy or other parts for that matter. It's actually a conversation which is very, very similar to the conversation, but from a different angle about households and loans in the household sector, because we have exactly the same discussion: what is monetary policy and what is the rest, and how do we balance that? And I mean, these issues are non-trivial when it comes to coming up with a reasonable balance of doing these things. And one reason for them being non-trivial is that you mix the conjuncture with structural issues, and that's always hard to do, and it's always hard to figure out what is what, and it's always also difficult to. And there's a tendency sometimes, this is my own view, to become a bit too nearsighted, in the sense that it's easy to say that everything is the conjuncture, and for that reason you should always increase aggregate demand in one way or the other. And then we know that if the structural issues fall by the wayside, which is not specific to the labor market at all, then that comes back to haunt you later. But it's hard to balance these things, right?
Yeah, because one of your colleagues is very adamant that a lower repo rate would have created more jobs, looking backwards, and I guess it would be very hard to say that's for certain.
It's difficult to know. That's a hypothetical question when you do the numbers, because in the end, monetary policy is always about all things considered. It's not only about the labor market, or not only about household borrowing.
I have a question concerning the forecast of the household debt ratio. This is the first time I've seen you actually make an explicit forecast. Yeah. How should we interpret this? Is this? It seems to be a precondition almost for the repo path going forward.
Not a precondition in the sense that everything hinges on one particular number, but it's in there as something that matters. And in that sense, it's adding something to the conversation. I think it's a good thing, because particularly if you read the minutes, you find at least a few board members who have reflected on what's going on in the household market since 1999, actually. And then it's about time that it shows up in the numbers.
Yeah, one could even argue that it's too late, I guess, given that we are where we are. But
point is well taken.
Actually, just a minor correction. We have had it in the report earlier, but it hasn't been in such a prominent, it hasn't been where it's. So it's been in the report earlier, but.
In the financial stability report.
Yeah.
But I mean, that's one of the issues before us going forward. I mean, just kind of reflecting on monetary policy more broadly, or reflecting on focus on the transmission mechanism, if I call it that, is that we need to get better at combining what's in the financial stability report with what's in this report, and we need to reflect more on how do you describe the transmission mechanism, and how do you actually go about thinking about debt levels, and how do you include that in your thinking when you argue back and forth about monetary policy? Because it's striking if we look at how the models have been designed. They only deal with price, no quantities. But we have learned the hard way that debt levels matter. And in that sense, when it comes to, and this is actually pretty much the same for fiscal policy as monetary policy, that you can act and do things with a kind of a confidence interval. But if you end up outside that, then you have difficulties. And this is exactly one of the difficulties that they're struggling with in Southern Europe when it comes to too much government debt. But the basic issue tends to be the same, in my view, regardless of whose debt it happens to be. If the households have borrowed too much and eventually that comes home to roost, then you have a problem. If the corporate sector has borrowed too much, because take our own example, in the late 80s, all of that good part of that money went into commercial real estate. Then eventually, when these things start to unfold, aggregate demand takes a hit, and you have a hard time putting the pieces back together. But how to include this in the modeling and how to ideally carry out an informed conversation about this and translating that into an interest rate path. That's a tall order.
I have a second question on that, or a follow-up question. I remember at the last meeting, you specifically mentioned that this subject was not on the table. How do we know when it is on the table? Should we assume from here on after that it will always be on the table now, or?
By reading the minutes?
Yeah, but I mean, obviously last time it was not the subject which was discussed very much.
No, but
I remember you saying it specifically.
Right, because I got the question and I answered the question. But if you think about how we carry out a conversation about monetary policy and how we sort of argue back and forth among the six of us about the future, and then I'm not only talking about what ends up in the minutes, I'm talking about the full process, which takes actually many weeks with many meetings, and that how we go about actually doing that has been described in various articles. Then you get a huge number of potential variables to talk about, and it's not that you go through a list and tick off each variable one by one each time. This varies over time, and because in an uncertain world there is always something new to worry about. But as a general reflection, the more the debt level goes up, regardless of whose debt it is, the more likely it is that that particular issue will stay on the agenda, because that increases the vulnerabilities in the system, and then that's why you end up actually focusing on it. In our case, we're talking about household debt. In other countries or in other times, fiscal dominance has been an issue, which is usually about fiscal debt, has been very, very high on the agenda. But then there is not that element of precision to it, in the sense that you can say that in each and every meeting we're going to talk exactly about this or that. That varies over time.
If you look at the repo path, looking out to 2013 and 14, we have increasing rates, but at a much slower pace than you had in the 2010 and 2011. At the same time, you have unemployment improvements that are about the same speed as you had in 2010 and 11. So I wonder if you could comment something on why you see a much slower increases going forward, while the labour market still improves over the forecast period. Basically, what I'm asking is, you see unemployment go down to 6.5%, while the repo rate ends only at 2.5%.
We make these assessments at different points in time. There are no fixed relationships between the interest rate and unemployment. So this is part of this is the red line here is the outcome of an analysis that looks at very many different factors. I guess I should remember what was going on in 2010, and I guess we had a different outlook for the euro area there. A better outlook, but there are no fixed relationships between the interest rate path and unemployment paths, for example. So
your assessments around matching on the labour market has nothing to do with how you see this
Christina Nyman could perhaps help
Well, I
me
can
out here
just
as
add,
well.
one thing that is different is the global interest rates that we expect are much lower now than in 2010. So we have almost, as you know, flat interest rate in US and the euro area. And this is something that affects the Swedish economy as well through the exchange rate and therefore also the repo rate path.
I mean, one way of reflecting on this, if you look at the unemployment graph here during the 2000s, and you can see that unemployment has been going up and down between 6 to a little bit above 8%. And during this time period, we have had many different interest rates. One of the issues before us, which I touched on earlier today a little bit, was to say that if you look at, let's say, GDP numbers appear to be much more volatile today than, let's say, 5 years ago or 10 years ago. And part of that is that we had this period that we ended up calling the Great Moderation, and everything looked stable, nice, and calm, and was supposed to stay that way forever. Now, didn't end up that way, and things have been actually quite volatile since. We are now 5 years into this period, whatever that means. And that, of course, means that in terms of the modeling and the calibration of the models, they're basically done on yesterday. And at some stage, of course, we and many others will have to ask ourselves how to think about new future equilibrium assumptions, whatever they might be. And of course, part of this is kind of gradually picked up by the models. But one issue before us and many is to sort of say, okay, all this stuff is based on an assumption that the long-term equilibrium repo rate is around 4%. The good question is to ask, is that really the case? Well, that's future homework, and it's very, very difficult to answer those types of questions. And you get exactly the same issue when you sort of think about the repo rate and the labor market. So, with all the imperfections in this is our best assumption going forward.
Probably a bit tiresome about this debt ratio, but still, if one, assuming that your forecast is for roughly a stable debt ratio, how do you perceive a good scenario where
the good scenario is that it stays there.
That it stays
that
there.
That it is stable.
No decline or
Well,
no long term.
I wouldn't complain if the debt ratio were to decline. That's for sure. But we also know that these things take time. So these things just don't happen overnight. And that basically because in order to make a debt ratio decline, you're going to have a change in behavior, and you're going to have kind of one cohort of borrowers after another that change their behavior over time, and that doesn't happen overnight.
And I assume that will only take place in a growth scenario, that you have this kind of positive.
Well, in the growth scenario, it's of course easier because then disposable income goes up, and it makes it easier to pay for whatever you have to pay for, including paying interest or increasing amortization. So in that sense, from this perspective, growth is always a good thing. But the hard part of it is that it's very difficult to engineer an evolutionary path such that these things are so that the sailing in some sense is always smooth. And that's exactly why it is always worrisome if debt goes up for 15 years or 20 years or a very, very long time period, because that gradually increases the vulnerabilities in the system. And it's not only an issue about, let's say, what were to happen for the sake of the argument to individual households, because that's very, very painful in itself. But I think that way before you get to that point, given that regardless how wealthy you think you are, or how wealthy you feel you are, amortizations and interest payments have to come out of current income, because it's always the cash flow that determines your capacity to pay. And in that kind of an environment, way before you end up having a problem with your loan, consumption is going to take a hit. And then that, of course, is likely to affect the whole economy in one way or the other. And then that's, of course, one would like to avoid that kind of a scenario. And one way of avoiding it, and here in my view we are behind schedule in our country, and that's to sort out how we deal with what nowadays is called the macro-prudential issues, which is like loan ceilings, capital charge on banks, the liquidity coverage ratio, maybe a debt-to-income reflections, amortization requirements, and all those things that people are talking about nowadays. Because this is something which is very much debated in many other parts of the world, and they have in some other places they have been quicker when it comes to putting in place an institutional framework dealing with these issues. Well, we haven't been able to do so far, and that runs the risk, in my view, of producing an indecision bias. And of course, the more indecision bias there is, the more you put on monetary policy in one way or the other.
I have a question regarding the transmission mechanism, perhaps mostly the interest rate channel. We have seen for some parts of this year lower mortgage rates from the mortgage lending institutes, not only due to the rate cuts from the Riksbank, but also to kind of improve market conditions for these mortgage lenders. And my question is, how do you interpret the kind of transmission mechanism in your policy stance from meeting to meeting? Is it something you see as a fixed factor, or do you look at it at a more dynamic way?
It used to be a more fixed factor than it is today.
That doesn't say much.
No, because it's hard to deal with, because, as I said, the world is much more volatile today than it used to be, and that means that we have more focus on this than in the past, but we need to focus on it even more. And then that runs into some technical issues also when it comes to making assumptions about interest rate margins and how they will move over time, and what will happen. And there, if you kind of break it down into individual policy meetings, and then particularly, let's say this time when it's only about 6 weeks between two policy meetings, very hard to deal with, because there's a high random element to that. But it's certainly something which is well worth keeping an eye on. And then I think that we are in a very good position compared to many other countries, because we don't have what others call an impaired transmission mechanism. We can carry out a conversation the way you asked me about, what happened with this margin, and does it matter, and where it's going to go, and things like that. It's much worse if you go, let's say, to Spain and other places where the banking sector doesn't really function properly anymore, because then you really have an issue of what is the connection between monetary policy via the banking sector out to the economy as a whole. And the more difficulties you have in the banking sector, the more issues you have with the transmission mechanism, most likely the less bang for the buck are you going to get when it comes to moving the policy rate up and down.
We actually have a graph that you've seen before. So that's the spread between the policy rate and then lending rates to households and companies, just to illustrate what Stefan has just said. And it was the case many years ago that we did not spend too much time on the difference between the red curve and the blue and yellow, but we do spend more time on a considerable more amount of time on that nowadays. But you also see from this graph that the policy rate is a pretty important determining factor for these other interest rates. So monetary policy is still very important for interest rates to households and companies. There's no disconnect between those.
I mean, you can argue about this, let's say, within a 1 month or 2 month time span, but eventually, as you can see, these rates, one way or the other, on average, follow the policy rate very closely, which is, of course, a nice thing. But it certainly deserves more attention than in the past. But another way of looking at this is also to say that this really requires that the banking sector is stable, because otherwise it wouldn't be there. So that means that capital requirements have to be high. We have to have all these other things that we do in place, so that there is a general perception here, and not the least in the rest of the world, that our banks are okay, and that this system is functioning the way you can see on these graphs.
Question about your underlying inflation forecast. Looking at the end of 2013-14, your inflation forecast is the inflation goes up relatively markedly, despite that you have about the same cost, the domestic cost pressure, in 2014 compared with 2013. What's your reason, or what's the factor behind the inflation pickup in 1 year from now?
It's part of the general outlook that as you're going forward, wages will pick up, resource utilization will pick up, there will be more demand. So
the same domestic unit labor cost in 2014.
Yeah, but I guess to that you have to then add demand side pressures. Yeah, so if you look at our measures of resource, different gaps, you will see that they also close around that time. So all of those together point to the fact that inflation will be around 2%.
Can just add to that we also think that the inflation is low today because of the krona, the appreciation of the krona. And as you maybe have seen in our forecast, we expect the krona to be at this level, about this level going forward. And in a couple of years, then these dampening effects from the exchange rate will diminish. So that will actually increase. And if you look at services, inflation in services, for example, it's about 2% now. So it's actually goods that are are falling. Prices are falling on goods, and we think that's connected to the exchange rate.
But when it comes to the exchange rate, I'm still talking for myself, trying to get my head around using the KIX index, which means that you have to move down to between 100 and 105, something like that. But it doesn't matter, of course, when it comes to the direction, but given that we have used the other TZW for so long, it's going to take a while to get used to the new numbers.
Not about that this time. More on your economic forecast as such. I think you're still on the optimistic side of most forecasters, as far as I can judge, for next year. I mean,
in outlook for Swedish economy,
Swedish economy, and I suppose also for the global economy. I just wonder.
I think we're where the others are. I don't think we're pessimistic or optimistic. I think we're where the others are.
Okay, but let me phrase it this way: what are the driving forces behind this recovery then in international growth? Given that, I mean, monetary policy rates on most accounts is very low, and fiscal policy is almost used up fully. You have the fiscal cliff in the US and so on. Where is growth coming from?
For example, in the euro area, I mean, our assumption is that measures are taken so that the uncertainty is gradually resolved, and confidence will return to consumers and firms, and growth will pick up. I mean, we have 2 years of zero growth in the euro area, but after that it will pick up. If you look at the U.S. economy, things are looking much better in the help me out, bostadsmarknaden. In the housing market, thank you. In the housing markets, profits are good in the corporate sector. And again, our forecasts for the U.S. economy are
Slowing. Yeah.
I'm sorry?
They seem to be slowing profits.
But still, I think looking ahead, we expect good numbers. And of course, we have other parts in the world that are growing a little bit slower than before, but still at very, very high rates. And all these things considered together are a reason why we expect inflation and growth in Sweden and inflation in Sweden to pick up.
Now we do think, and as I pointed out earlier, it benefits us looking at the KICS growth path here, the gray line there, that we, on the one hand, are quite dependent on exports to the euro area, but on the other hand, at the same time, over the past, let's say, 20 years, we have exported more and more and more to other parts of the world, and that benefits us. And not the least, they have had a very, very good run in Norway, which has been quite actually helpful when it comes to growth numbers. Any more questions? If not, thank you for listening in wherever you are in the world, and thank you for coming, and have a good day.
Thank you.